Alrighty, good and rising, everybody. How's everybody doing today? Hopefully, you guys are doing well. Gonna start a real fast live stream this fine Saturday rising. We're gonna be diving into the CyberX research channel, jumping into some of the panel discussions that have been recently shared via the researchers. Remember that at any moment in time, you guys want to tap into our vast catalog of in-depth research, all the information that the mainstream media never covers, all the information that people want to find, the videos, the panel discussions, the summits, the crypto briefings that take place are all available inside the private CyberX Discord. All of the documents from large financial institutions, these systemically important organizations, all available inside our private community for your guys's just honest to God deep research. Everybody should be doing this type of deep research. So this Saturday, we're going to be diving in. Today, we're going to be watching a couple of panel discussions. I'll give you guys a little bit of my time today. As I mentioned, we are going to be starting these streams, myself and Aqua, on Fridays when we're not doing, we're going to be doing these streams throughout the week on days that we're not doing our Friday podcast, and we're just going to be streaming some of the information and research that's inside the private CyberX Discord because there's just so much juicy, valuable info. So this one piqued my interest today. This is the Canary Capital CEO. We're going to be diving into a podcast that he was on with Wealthion, coming over here, sharing this tab. Steve McClurg, I believe is his name, CEO of Canary Capital. Let's take a second and just listen to his opinion. And if this doesn't turn out to be a juicy podcast, then we'll go ahead and we'll switch it up. I'll probably run through 2 or 3 panels today before hopping off with you guys on this fine Saturday. But anyways, many blessings to you guys. Hopefully you all are doing well. Share this live stream. Let's get it cracking. Let's jump in.
October 4th was the peak of this cycle, and we're already down 30% from that level. And I expect another 30%.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free.
Ladies and gentlemen, welcome back to the Wealthion podcast. I'm your host, Chris Perkins, President, Managing Partner at CoinFund. Today, I am with my friend, Steve McClurg. Steve is the CEO of Canary, which has had some really amazing success recently with the launch of the XRP, or the Ripple ETF. I want to hear all about. Steve has a pretty robust background, comes from traditional finance, spent some time at Guggenheim, Galaxy, Valkyrie, and now he's at Canary. So welcome, Steve.
Hey, Chris, thanks for having me.
Tell us about Canary as we get into it. I mean, these markets are so perplexing to me. I can't wait to get your take. But let's talk about what you're building at Canary and the products that you offer.
Yeah, absolutely. So, when I started Canary about a year and a half ago, I actually didn't think that I was going to get back into the ETF business. I kind of fell into it accidentally the first time when I was at Guggenheim. I was managing mostly institutional money for insurance companies, pension funds, and of course hedge funds. And we bought a couple of ETF companies, and we're like, okay, we're going to try something a little different here in the way that we, and the way that ETFs are managed. So we thought that we would introduce more esoteric fixed income products, active products. And back then, it probably doesn't sound interesting, but back then it was pretty unique. There really weren't many, if any at all, active ETFs, and particularly fixed income was really emerging as a theme. It was mostly equities at the time. So we brought in things like asset-backed securities, and so we brought in just a little bit more of a unique take, and then even a unique take in distribution, without utilizing as many salespeople as many others do. We focused on thought leadership. And anyway, fast forward to Valkyrie. Again, we initially weren't planning on launching ETFs. We saw an opportunity for Bitcoin, so we did it, and felt like we were also a little bit unique there. And then Canary, same thing. We launched Canary a year and a half ago. We thought we would be focusing on running hedge funds and active private products. And then, as I mentioned earlier, when it looked like Trump could potentially win, we're like, well, this could change everything, and there might be an opening for altcoin ETFs.
Yeah.
So first of all, we filed for the two that we felt like were not securities. Gensler had given a speech where he said Bitcoin, Ethereum, Litecoin are not securities. We're like, well, nobody's filed for a Litecoin ETF, so let's file that one. And then the second one was HBAR, and a lot of people kind of scratched their heads and they were like, well, why HBAR? It was because, number one, that HBAR had actually filed as a commodity.
Yeah.
So it also was clearly in the non-security camp. And we also felt like it had a very strong ecosystem, very strong audience, big following that was kind of unique to the rest of crypto. And, it was a bit of a gamble, and it ended up working out. And then, of course, the next two largest ones, XRP and Solana, which are, kind of the obvious choices. But that's how we got started. And then we just kept going on things that we thought that would have a market and that we thought were, decent tokens to be in.
That's awesome. I think ETFs and crypto have a degree of ideological alignment. And the reason why is, like, you kind of talked about it in the beginning, where an ETF, you can put esoteric products within that, make it very simple, wrap it in an equity essentially, and then open it up to the masses. And so as you were talking about, some of those assets that you used to, wrap in ETFs, ordinary folks couldn't access them.
Yeah.
And like now, same goes for crypto. It's not always easy. My dad's like, finally came around. He's like, I want to buy Ethereum. And the easiest way for him to do it was via an ETF. I mean, do you see that alignment? Is that, is this all part of a democratization play? Gosh, I messed that up.
No, it absolutely is a democratization play. I mean, I totally understand what you're saying there. Going back to even the fixed income, anybody who's a bond trader knows that if you're trading large volumes, your spreads are pretty tight.
Yeah.
But once you start getting into, mid-sized small shops and they're doing, less volume, less total size, your spreads get really wide. And then when you get down to retail, like financial advisors, their spreads are extremely wide.
Yeah.
I mean, we're talking like a full point, right? Or more, that they end up charging their end client on just the spread. And if you're retail, it's even more so. So when you put that into an ETF and you're a larger company that is axed on bonds across the board, your spreads are going to be tighter. You're going to deliver a better result to the end client that normally wouldn't even be able to trade it at decent levels. Same thing goes with crypto. Most of retail is trading crypto on an exchange, and they're getting charged massive fees.
Yeah,
we're talking $100 a trade.
Yeah, it's insane.
Plus the spread.
Yep.
So when you think about an ETF, charging, up to 1 point, you've already won by buying an ETF when you're talking about pennies spread on the exchange, and then you're only paying a 1% management fee.
Yep.
I mean, you make that up, within years.
Yeah. Who are your clients, Steve? Is this largely been retails and institutions, FAs?
Yeah, it's a little bit of both. A lot of our clients are retail. I'd say about probably 20 to 30%. It's hard to tell in ETFs because the way it goes through, but you can see, who the brokerages are. So it's probably 20, 30% retail, and it's probably about 70%. I don't want to call it institutional, but it's probably 70% fast money at the moment.
Yeah, I think we're seeing, I've been talking about this constantly, more of an I think institutions are coming in, and and institutions is a crazy word. It means a lot of things to a lot of people, but definitely there's an easier appeal for them because it's just another security, piece of cake, traded out of my brokerage account right into my PMS, piece of cake. All right, so you talked about some of your products. I mean, you guys were one of the first to launch the XRP ETF, and that's been very successful. How do you think about introducing new ETFs, underliers? Like, how do you think about the tokens that you want to bring to market?
Yeah, it's really two different areas that we're looking at when we're looking at new tokens. One of them is, do we believe that there's a demand there? And we look at things like volume, market cap. Is it trading in the US at all? And we don't just look in the US. We look at the global markets, because the reality is globally, there are investors in ETFs in the US. Take UAE, for example. UAE has its own ETF market, its own ETF exchanges, its own capital markets, but it's really light volume, so the spreads are wider. And given the tax structure in the UAE, they're often buying US-based ETFs because even after paying taxes, the spreads are so thin that they're actually making out. So we're not just, we're mainly focused in the US, but we're also looking at demand globally. So we're looking at that, and we're also trying to make sure that it's not something that might go away in the next 1 or 2 years, right? A good example, or there's several examples of cryptocurrencies that have come. They had a lot of promise. They had great teams. The teams left, and the token just sort of went to zero. So we're trying to make sure that that doesn't happen with some of the projects that we're selecting. We're going to get it wrong, but that is the goal. We're strong believers again in the first 4 that we launched: Litecoin, HBAR, XRP, Solana. Those teams have been around forever. They're not going anywhere, and they're building something that's actually being used.
There seems to be a first mover advantage in the ETF space as well, as you seek liquidity. And does that factor into your calculus? Is that one of your differentiators, first to market?
Yeah, I would say most of the time, 3 out of the 4 that we've launched so far, that we were the first mover in a spot on a pure spot basis. There were a couple of ETFs that came earlier that were, I would call them hybrids. They had some futures, they had some non-US ETPs in them. They had a little bit of exposure to tokens, and those aren't perfect structures. I get why some issuers put them out there, because they want to give you the ability to buy something. But then when the SEC gets over the line on the actual spot product, the spot product is superior. And so we're hoping to be at least first or second in every one that we do. Again, one of them we were 5th to market, so we try not to do that one too often.
Yeah, and so we've seen a big focus on single name ETFs, single name token ETFs, like you talked about HBAR, et cetera, XRP, Solana. Going forward, do you expect to bring a lot more sophistication and underlying structures, multi-token ETFs? How's that? Or are you just going to continue to go down the alt path and go down to the top 50? How do you see your ETF products progressing?
Yeah, I think the next stage that we're into is really a lot of protocols that we think have a good amount of promise. So they might not be top 10 in market cap, but they certainly have developers building on them. They certainly have great teams. I expect the next 4 to be really interesting, that we expect to launch in Q1. But as far as sophistication goes, we would love to launch an actively managed ETF for crypto. At the moment, the generic listing standards only allow for certain tokens, and even if it's an index, it has to be passive. So we're playing by those rules at the moment, but we have filed for one index that is, I think it's kind of fun and unique, but we did file for one, and we're going to work on that over the next few months and hopefully get it launched in 2026. But it is a unique take on an index. We're really focusing on blockchains that are made in America, and we believe that there's going to be some benefit to that in the coming years.
I think you need an American flag there behind your desk. I think that's I just noticed it's missing, but I hear you. One of the biggest issues that I've seen with market structure and an inability to really scale, you mentioned the generic listing standards. We just don't have futures in this country, and it's an abomination in my mind. We have a company, Quatrefoil Data Services, that's trying to help facilitate the launching of futures in the U.S. for a couple of reasons. Number one, if you have a future, then you can avail yourself of those generic listing standards. And number two, it opens up basis trading, which is where you buy the spot, you sell the future, and you can generate really nice yield. That seems to be one of the first stops for a lot of institutions. Do you agree with me, or am I crazy? Like, do we need futures in this country bad to really unlock, everything that you're building on the spot and ETF side?
No, that's absolutely right. So the way the generic listing standards work right now is that, and I know you know this, but this is more for the audience, but the way that it is right now, that if you've had a futures market in the US for 6 months or more, then it qualifies to be able to have a single token 33 Act fund. There is another path, and that's having 40 Act. And there's a couple of ways to approach that. Number one, again, goes back to futures. So you can take a new futures, let's say that a futures market that's only been out for 1 or 2 months, and wrap it in a 40 Act and launch it as say a 2X ETF, or even a single token ETF that's all futures based, and then 33 Act qualifies.
Yeah.
So, but it really all comes back to futures. I mean, there's a few exceptions, but and then second of all, I mean, and you said this again, the basis trade is really what's driving crypto ETFs at the moment. One of the reasons why there's been a lot of outflows in Bitcoin spot ETFs is because the basis trade collapsed.
Yeah.
And we've benefited from, launching XRP and HBAR primarily because there's a great basis trade there. And so we've seen, ever since those two have launched, even in a down market, there's not been a single day of outflows.
Yeah, but HBAR is not even listed futures on a major exchange yet. Just wait until that happens.
Oh, absolutely.
Yeah,
I mean, it's on one exchange, but it's but that's really it. It's on Coinbase.
Yeah.
But yeah, once you're on a major exchange, then forget about it.
And like we've been looking at this constantly at our shop. We're obsessed with the basis. And what we've noticed is that when it hits around 7% or so, you see inflows on the ETF side. And the problem is when it comes down underneath 7, now you're starting to compete with traditional products. And like, why take that risk? And so if there's any alpha that we can provide on the show, watch the basis, and that will tell you, how exciting buying spot, selling future is. And if you buy spot and you sell future, guess what happens to spot? It goes up. So, and when that basis is no longer appealing, they take off the trade, spot comes down. So it's something that we've been watching pretty maniacally, something I think everyone should look at. Anyway, do you agree?
Yeah, look, there's 2 factors that have really been driving the market this year, and basis is one of them.
Yeah.
So I think it's extremely important.
What's the other one?
Well, the other one's Bitcoin miners. There's a lot of people out there that believe the 4-year cycle's broken. I don't believe that it is. I think miners still have a large supply of Bitcoin and will continue to until the halving gets to a point to where it doesn't matter anymore. But it does matter enough to where this whole year you've had an increase of AI data centers being built, and electricity prices have gone up. So a lot of miners lock in their electricity price. A lot of them don't. And the ones that don't have been forced sellers of Bitcoin in order to pay their bills. And then what happens is the other miners that have fixed fees because Bitcoin isn't going up as much as they expected this year, they're capitulating and selling their Bitcoin. And then some of the miners that are publicly traded that are buying Bitcoin and trying to make themselves a DAT and a Bitcoin mining company, they're also forced to sell. So you're seeing a lot of capitulation among Bitcoin miners, along with that basis collapsing.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's Hard Assets.
Because I've got ETFs, I've got institutional inflows. Look what Trump's doing. Like, the policies are coming into place. They're not attacking us anymore. The conditions are awesome. But like when you look at the numbers, Bitcoin is down, like 11% year to date. NASDAQ is up like close to 17%. I guess NASDAQ isn't focused on this, the halving or the 4-year cycle how do you make sense of this, Steve?
I mean, I've been watching, as you have too. I've been watching this for years and investing for years. And I always get the best signal from the miners. I show up incognito at Bitcoin mining conferences. I walk around. I talk to people that have no idea what I do or who I am at all. I'm talking to the energy providers, the energy brokers. I'm talking to the teams that are selling the miners and any other equipment that's out there. And I'm trying to find out what's going on along the supply chain. And I usually come back with good information. And I want to say back in May, I attended a Bitcoin mining conference and talked to all the energy providers. I was like, oh crap, Bitcoin mining is in trouble this year.
Mhm.
And and so many of them are shifting their sales over to AI data centers. They don't care about the miners anymore. Bitcoin mining companies are starting to shift over to AI data center
For sure.
capacity. And you can just see it, right? And
Yep.
and by the way, I'm also a partner in a small mining company in Utah, and we're seeing it firsthand there. Now we're a little bit different because we're using stranded solar, so we're not affected by the energy price.
Mhm.
But we're constantly talking to all the suppliers, and we kind of know what's happening. But that's where I've always gotten my best signal from the suppliers to Bitcoin mining companies, and this was the signal.
I totally don't agree with you about being incognito anywhere. If you guys ever look at Steve in person, he's a towering figure. Everyone knows him, but I'll agree for you. I'll just believe you for now.
Hey, when you're at Texas Bitcoin mining conferences and you're there with a bunch of cowboys in boots that are also
All right.
6'4", yeah, you blend in.
Fair enough. So that's Bitcoin. How does the softness reverse? What is it going to take? Just you got to wait out the cycle, or is there something that's going to spur it forward?
Well, and again, going back, my theory on the 4-year cycle is that the impact will be less and less every year, but
Yeah.
it will still have an impact.
Okay.
So my theory is that October 4th was the peak of this cycle, and we're already down 30% from that level. And I expect another 30%. So if you go back to previous cycles, the impact, the drawdown has been less and less and less every 4 years.
Yeah.
And I think the drawdown this time is going to be less. It's going to be a little bit more moderate, a little more muted. You're not going to see a 75% drawdown. It might be a total of, I don't know, 50 to 60. And if you also look at previous cycles, it usually takes about a year. And look,
Yeah.
every cycle is going to be a little different, but about a year from peak to trough. And I expect the trough to actually be a little bit earlier in 2026, probably sometime over the summer. Because as you said, we've got other factors, right? We've got
Yeah.
institutions coming in. We've got an administration that likes crypto. But on top of that, we'll probably have a change in the head of the Fed.
Yep.
Sometime in May, we'll start seeing interest rates drop again. And then, the rally begins.
Where do we bottom? 60K?
Yeah, I think so. I would say 65 was my guess, but what do I know?
All right. So we talked about Bitcoin. That leads me to alts, and alts has been hammered this cycle. I think we were looking at a top 100 index down. Guess what? It's down.
What is it? I'm curious.
It's down like 60%, right?
Wow. Yeah.
So alts have not. We've been in this bear market of sorts for alts. But that said, as with my silly institutional mind, I was, first drawn into the space, not by Bitcoin, which I got it. I'm like, okay, digital gold, I see it, it stands there. But like what really got me going at first was Ethereum, and then learning about smart contracts and all the financialization. And now you're hearing about Canton and announcement after announcement. DTCC made an announcement yesterday. All these institutions are marching forward because our minds are focused on utility, that a lot of these alts bring, but they've been getting slayed. How do you see the alt market emerging?
Yeah, look, I got into this for the exact same reason and had the exact same beliefs. Smart contracts I found super interesting. I saw a path for global remittances and tokenization of esoteric, products in the real world. But I liked Bitcoin too as money. But look, what I think is going to happen in 2026 is we're going to have a very interesting cycle where price isn't going to match opportunity. Prices are going to be kind of muted, as you mentioned, already down 60% across the board in alts, 30% in Bitcoin. We'll probably see the price drop even further, but I'm watching and I'm expecting even more of this, and that is building things like tokenization, building rails where we can move money globally, cheaper, faster. So usually in cycles when the price goes down, the companies suffer. But I think this is going to be a situation where price goes down and a lot of companies thrive because of the open environment here in the US, as well as all the really cool things that are finally being built that I was hoping for 10 years ago.
It's interesting. I had Santi on. Santi over at Inversion. He's in the private equity space, and he was making the point, I don't really care about the token. He uses Avalanche actually. I don't care about Avalanche's token price. I just love the technology. And what I'm doing is I'm buying these companies, I'm putting them on chain, so they're going to realize real cost savings and efficiencies, and their stock is going to go up. And their private equity valuation is going to go up. So it's an interesting thesis. What do you think about that?
Yeah, well, I've always been suspicious of Ethereum just because I'm like, look, the technology is amazing. A lot of people are using it, but it's really easy to copy the code and build your own fork. Make, like if you're a company like JP Morgan, right, and you want to have your own blockchain, you just take Ethereum's code and build it in house, and that's exactly what they did. So a lot of people are going to do that. A lot of people are going to use the chain itself, and what's going to end up happening is the token price is going to probably come down to where it matches what actual gas is being used. And by the way, if gas is too expensive, then people will probably move to another chain. So you're going to see more of a competition on some protocols. So you might see some price depreciation because of its real use and real revenue.
I'm on the other side of that one. I'll be honest, I'm more bullish than you because I just see too many good things happening in the background. Bitcoin, Ethereum, and beyond. My bull case on Ethereum is like, look, it's got 10 years of history. Nobody else has 10 years of history. That's going to be the first port of entry. And the layer 2 roadmap, I think they can modularize things and give those institutions the control that they want. And I think there's an ongoing question around the value of the network itself, and the security and the million validators versus the actual value accrual. And that's a debate that people are continually having. But like, as I step back, I look at, a Fed, and I want to get your thoughts on macro. I see a Fed that is definitely turning dovish. We've gone from QT, the era of QT ended on December 1st. Crypto prices, especially alts, have been very reflexive to liquidity. So that looks to be moving in our favor. We're going to have a new chairman of the Fed. And I'm about 100% sure to become chairman of the Fed, you have to be dovish. And so it feels like macro, you have midterm elections coming on. Trump just gave a 1776 check to every single military person. So there's going to be stimulus that's happening, macro and micro. I mean, it just feels to me like there are too many good things happening, as we approach midterms that are going to be very positive for price. And like, maybe we're saying the same thing. You're like, hey, beginning of 26, maybe not so much, but then as we edge towards its elections, am I wrong? Am I too bullish here? What's going on?
No, look, you're not too bullish, and the difference between us, Chris, is that you're a derivatives trader. I'm a bond trader, so you're always looking for a way. You're finding bullish opportunities, and I just think everything's bad, and then I try to mitigate risk. I mean, that's just the nature of who we are. But I do agree with you that there's a lot of great tailwinds, and but at the same time, the Fed has been too slow in lowering rates. And I don't agree with what the Fed is doing right now, buying more assets back into the balance sheet. What that's causing is the curve to continue to be inverted. Because if you're buying, T-bills up to 2 year, 2 years trading less than 3 month. And so the Fed rate is actually artificially holding the short end of the curve up, while the Fed is buying T-bills and pushing down, 1 year, 2 year, 9 month, 6 month to lower levels. I think the Fed should be continuing to unwind the balance sheet while lowering rates, so that we can get a normal curve again, and that you can get, you can get paid for the risk that you're taking by taking on more duration. Yeah. So that's the big thing right now. I do think that the longer the Fed takes to lower rates to the appropriate level, which right now I believe it should be about 3.25, the longer it takes, the more they're going to have to lower rates. But while we're waiting for a new Fed chair and a new Fed to come in to actually lower rates to probably below appropriate levels, is what's going to happen. In the meantime, about 90% of the population, and I don't call it a K-shaped recovery because we're not really recovering from anything. It's just a K-shaped economy, where about 90% of the population can't afford groceries, can't afford their mortgage. They're defaulting on their credit cards. They're defaulting on their auto loans. And all of those are tied to the Fed fund rate. And the longer the Fed artificially holds that rate up, the more people are going to suffer. And that's why we're not having a lot of liquidity in the market from retail. Now, the top 10% of the population is actually still buying things, but we're starting to see cracks there too. So the longer it takes, the more action is going to have to be taken. And even looking at the unemployment rate, it's creeping up. 5% is the natural number. It's only at 4.6, but it's been creeping up. And that momentum, when it starts moving, then we will probably surpass 5%. And that means a lot of people out of jobs. People aren't buying presents for Christmas. Amazon's already laying off people. So those are the headwinds happening today, which is causing this K-shaped economy. And it'll take about 6 months for that pendulum to swing the other way and for things to start moving again. And that's why I'm, my target of, okay, we'll trough sometime, probably late summer, while all these issues work themselves out. And then the economy can start recovering again.
Yeah. Well, we had a good CPI print today, at least. But Steve,
Yes.
what do you think about stable coins? I mean, I think the adoption has been a little bit slower, but I'm seeing all these machines, these institutional machines, getting ready to just pump out stable coins like nobody's business. I called 500 billion by year end. I think we're going to be around 300. I could see that, that could just exponentially rise, and really by having this incredibly massive new buyer of short-term treasuries, it could keep yields down. What's your view on stable coins and their impact on the economy?
Look, I love stable coins, and it does actually help with it creates a new seller for bonds, essentially. Yep. As other countries are starting to dump them. They're not necessarily dumping them, but they're selling off and threatening to dump them, which causes capitulation in price. But I love the stablecoin market. What I do want to see, though, is stablecoins that actually yield something for the end user. And right now, it can't. And by the way, I get why it can't. It's essentially a money market mutual fund if you start pushing for a yield, which means it's a registered product. And what the guidance is like, look, you start distributing a yield, you need to register as a security. And do I think that it shouldn't? No. I mean, I think there should be a path, though, to where maybe there's a registration for stable coins that are a little bit unique. And by the way, make this applicable to money market mutual funds as well, so that you have an instrument that you can trade around that actually pays you a yield. Right now, the companies are making a ton of money off of just free yield off of everybody else's bonds.
It's pretty crazy. There's like a Braveheart style battle going on right now in DC around rewards, right? And yes, you can't pay yield to end users. And like, it's such a brutal policy position to have. Be like, nope, we don't want individuals who hold our product to receive yield because, we want to protect them. We want to protect the system. So yeah, there's a brutal battle right now unwinding in DC where certain companies are trying to pay rewards, not interest. And other companies, particularly incumbents, are saying, no way. I don't know how that plays out, but it's all kind of wrapped up in the market structure. And I've been pretty bearish on market structure. I think it's going to be brutal. Yeah. And do you think that ever gets done? And what impact would that have on your markets?
I think it's going to be tough for something like that to get done. And I'm also pretty fearful that the midterms are probably going to flip.
Yeah,
at least one house to the Democrats. So once that happens, I think any kind of new market structure bill is dead.
Yeah, I don't think it matters personally because you're going to have the chairman of the SEC and CFTC, both of them I know, they're going to agree and they're going to say, hey, these are commodities, and that should be really good for your business, right? Because if you have a commodity and it's designated a commodity, it's very easy to launch an ETF, right? Because we'll have the futures.
Yeah, look, I can't say enough good things about Atkins. He's probably been the most libertarian chair of the SEC that we've had in a very long time, at least in my lifetime. And he's also fair though too, right? I mean, it's not like, willy-nilly, letting everything go. I mean, we've got some things out there that they're holding back. And by the way, I guess I don't really disagree with them. So, but I think they're being very fair on a lot of other things, and for the majority of the things out there. I mean, obviously, people like us, we're gonna push the limits some to see what we can get away with. But and they've been very adequate in saying, yeah, no, this isn't going to work, and we're like, all right, fine. I can see why that. I can see why you say that.
People don't realize this, but Chairman Atkins was actually chief of staff to a guy named Richard Breeden back in the 90s.
Oh, I didn't know that.
Oh, yeah. And when the Canadians started launching these ETFs, Breeden's like, what is this thing? And because I had lunch with Breeden not too long ago. Absolutely fascinating. And staff's like, I don't know. This stuff looks like it's dangerous. We don't understand it. And he's like, guys, listen, give me one reason why we're not able to do this. And he's like, you have X amount of time. They came back and they said, we don't have a reason not to do it. We just we're scared. He's like, do it. And guess who was, and who was his chief of staff? Paul Atkins.
Yeah.
So, his entire career has been around democratizing finance. Now he's really focused on equity market structure, which is going to be fascinating. What are your thoughts on internet capital markets? And you have ETFs today. Mm-hmm. You're launching them on exchanges. You got people like Superstate and others who are saying, Coinbase even now, like, hey, we want to start selling equities on chain, opening up the global, anyone with an internet, blah, blah, blah. I imagine that would be really good for your business. Is that something that you've thought about and you're supportive of?
Yeah, it really is. I mean, you watch, Kraken did it first, and now Coinbase is doing it. And, because what's happening is firms like Robinhood and Fidelity and Schwab, they're going the other direction. They're offering all the traditional products, and they're, some of them are already offering spot, and they're going to continue to offer more spot. And Coinbase and Kraken are like, we don't want to get squeezed out. So we're going to be at everything to everybody. And there's definitely an age gap too, right? People that trend a little bit older or skew older are going to be on, platforms like Schwab and Fidelity, and, younger people are going to be on Kraken and Coinbase. So it really is keeping eyeballs on one screen, and that's really, the goal of any company on the internet is to keep eyeballs on your website, or, in the age of the iPhone, on your app. You don't want people going to Schwab for here and Fidelity for here and Coinbase for here. So them offering equities is really offering another route for their existing clients to trade all in one spot. And I think that trend is going to continue to happen. It's going to be spot crypto. It's going to be futures. It's going to be ETFs. It's going to be equities. And I'm very happy about that. It also creates a lot of competition in the market, because right now, I mean, a lot of the native crypto apps or crypto exchanges charge a lot of money. Yeah. And now that they're getting into the game with, competing against Schwab, they're going to have to bring the prices down. The other thing about crypto native exchanges are, they're, now that ETFs are out there, they're not getting away with those high trade commissions anymore. Yeah. So their margins are getting squeezed. Same thing with custody, right? Custody used to be like 2 points. Yeah. And now it's coming down, in the basis points. 100%. So, yeah.
Yeah, we're absolutely seeing that compression. Generally, what happens then is you have consolidation and scale. Like only the biggest survive. So going right now, you're in this position where tokens are hard to access if you're an investor, and they're expensive. To your point, ETFs are a little bit easier to access, maybe a little bit more efficient. You got the DATs as well that are, have permanent capital trying to do what they do, not a pure like MNAV of one, not a pure exposure to the asset, but maybe more of an ecosystem play. Totally see the viability of ETFs today because it's just easier to access. How does this progress in time? Like in the future, are people going to want to buy, because everything's sorted, the prices align, operations align? Are people just going to buy spot? They're going to continue to buy ETFs? Will ETFs differentiate based on the strategies? Are these spot ETFs today just an interim fix until we figure it all out? How do those products evolve if you're an investor today?
Yeah, look, I think the first thing that goes away is going to be a lot of the DATs. I think some of them survive. Yeah. I think MicroStrategy survives. I think a couple of other, the biggest one in each category will probably survive. Everything else dies. They're just not efficient enough. There's a lot of smaller DATs that, by the time, it's sort of like a mutual fund, right? It's mutual funds are giant scams. You put $100 into a mutual fund, and then just off the top, your financial advisor is taking 5%, right? So you start off with a basis of 95, and then hope that you get back to 100 and start making money after that. And then when you sell it, and then of course there's a management fee that you're paying that's pretty steep. versus an ETF. And then when you sell it, there's usually another fee to sell, right? And it's just all kind of going in the pockets of the financial advisor. And so DATs look like a worse version of that, where you put money in. Bankers are taking 5 to 7%. Everybody and their mother's taking some kind of warrants that want to have some kind of participation. I've seen some deals where you've got firms that are the asset manager charging 3% management fees annually, and then wanting warrants. And then they're also saying, well, we'll invest too if you make us the asset manager at these fees and give us warrants. So there's just so much that's just bleeding out of a lot of these deals. And if you notice, there aren't that many deals now that altcoin ETFs are coming. So I think that it's good for some of the larger companies, larger coins. Those will survive. But a lot of the smaller ones are just going to go away. People are going to realize it's like, okay, I could pay 50 basis points for an XRP ETF, or I have all these operating costs and everything on top of it, plus upfront capital that I have to deal with. So in a lot of places it's going to be an inefficient vehicle.
Yeah, I think I don't disagree with you. I'm a little bit more bullish again, based on the underlying DAT. Like some of these guys are really sophisticated, know what they're doing. They're able to access public markets to do some amazing things and take advantage of maybe cheaper funding to drive, and there's certain projects that drive, beautiful yields, and you can do certain things and ecosystem plays. So yeah, but at the same time, there's plenty of crappy little DATs that need to go away, consolidate, et cetera. So yeah, I think like anything else, do your research. There are some interesting fundamentals out there. They're not all bad. They're not all good. Right. Just like tokens, right? You have to really fundamentally underwrite these things.
But by the way, my favorite DATs are the ones that are proof of stake, and they're just like, okay, we're running a validator, and we're going to put our own balance sheet in that validator, and we're taking outside money, and the yield is profit.
That's right.
Those are amazing DATs, by the way.
You said it much more eloquently than I just did, but that's exactly how I feel. And yeah, you're right. You can do stuff because you're not. Some of the problems, not problem, but like one of the challenges with ETFs are daily liquidity, right? Yeah. And that's why it's been so hard to launch, like an ETH total return ETF, because you have like 3 weeks of unbonding, and you can solve for it because you're a smart guy, but it's just sometimes it's not as easy to generate that yield. But it's also super expensive to run a public company, right?
Yeah, that's right. Yeah. Well, and then going back to, you also asked a question about ETFs. I think ETFs are going to be probably primarily used by financial advisors. Yeah. Because they're simple, they're clean, they can hold them in their accounts, they can explain it. I think DATs are going to be a little harder for financial advisors. I think DATs are going to be more a trading vehicle and used by more institutional investors. Mm-hmm. and then retail is going to be, I think eventually what's going to happen is retail is going to be focused on the token itself.
Got it. Yep.
But sometimes not. It's going to be split.
All right, man. As we come to the end of this thing, any big predictions for 26?
Yeah. Look, I mean, my biggest take is the peak is come and gone. We're in the down part of the 4-year cycle, and just sort of it's probably not going to be as bad as previous cycles. As far as the bear market goes. So, maybe another 30%, drawdown over the next 6 months. And then we might start seeing, recovery over the summer. So, keep building, keep your head down, stay humble, and then get ready to come back in next fall, probably after the midterms.
Sheesh. Could you all imagine the minds of the masses, especially the rhetoric on Twitter, if Bitcoin fell another 30%, considering altcoins are already down 60, 70, in some cases 80, in some cases making new all-time lows? What? People would freaking get crushed mentally if that took place. I personally believe that is something that is set to happen. Everybody thought that this generational wealth was going to be an easy road to the upside. I personally hold the perspective in cahoots with Steve that it is going to be much more painful before we start to see a substantial recovery. Nonetheless, right or wrong, ladies and gentlemen, we all know where this ecosystem is headed long term. tap into blue chip digital assets, projects that are building, just like this gentleman said, building, progressing, growing, partnering with financial institutions. So that way, when we do come out of this, whatever it is that we're in right now, pullback, bearish narrative, risk off sentiment temporarily, we are choosing projects that have longevity in this space. As always, bringing you guys some of the realest research and info. This was such a great podcast. This is the CEO of Canary Capital. These podcasts, these panel discussions can all be found inside the private CyberX Discord. There's hundreds, if not probably honestly thousands of updated panel discussions, the likes of the largest organizations, the banks, the financial institutions that run this stage, all of the summits, that most people have no idea are going on behind the scenes that people should be paying attention to and listening to can be found inside the private CyberX Discord. You guys can head over to cyberxtrading.com. Tap in with us. The researchers are working 24/7, 365, sharing all of the information that the mainstream media never covers. We're going to dive into a couple more panel discussions today. I have maybe like another one or two panel in terms of time to share with you guys today. I have time stamped here some panels. I want to get into the Canton network. Most people have no, idea what's going on with the Canton network right now. So I want to tap into a couple of these podcasts. If you guys don't know about the Canton network, definitely go do some research, but we're going to listen to some individual representatives from Digital Asset and the founder of the Canton network here. So let's tap in, let's lock in the chat. Many blessings. If you guys are CyberX Wealth 28 members or inside the private CyberX community, give me some flames in the chat. Love to see you guys on this fine Saturday, tapping into good information. Let's share screen and let's dive into this one.
Is just getting started. Transparency has always been the bug. Institutional adoption is just getting started. Transparency has always been the bug. I mean, it was even obvious to Satoshi. You go into the Bitcoin talk, he was very open and very clear about Bitcoin needs privacy to be really successful. We knew for an institutional adoption or adoption at scale that this was really a foundational issue.
How are institutions using stablecoins today?
The institutions are not really using stablecoins today. I think there's this misconception that stablecoins have found radical product market fit. It's just deeply inappropriate to use a public blockchain for these things. Imagine doing payroll on most public blockchains. You're effectively leaking the salaries of all your employees and the bonuses of all your employees to each other. You want the benefit of a blockchain, but you don't benefit from the whole world seeing all those activities. In many ways, it could be counterproductive. We really are the only ecosystem that can support privacy at scale in a compliant manner. Remittances, payments, payrolls, all that stuff is very easily accomplished with privacy in Canton. So if that is important to you because you're trying to move stablecoins at scale, you're trying to do capital markets at scale, you're trying to do anything at a scale, I think Canton is really a no-brainer.
Welcome to another episode, ladies and gentlemen. Today, I have with me Eric Saranicki. He is a co-founder at Digital Asset and Canton Network. Prior to this, he was also a co-founder at Cumberland, who's one of the larger liquidity providers out there in crypto. Welcome to the show, Eric.
Thank you. Thanks for having me.
Since 2017, we've been hearing about institutionalization of crypto, right? And it was made to sound as if it was imminent, and it is still underway, right? It has changed its flavors and the way it is happening. But one can really say that for the last 2 years, we've really seen institutions, dabbling into crypto, whether that is stable coins, RWAs, and whatnot. Can you just take us through how institutionalization has actually happened in crypto?
I think everybody has their own version of this story because it's still very much happening actively across the ecosystem. I don't know if there is one answer to it. But from my perspective, what I've experienced is an interesting mix. So I would say that the thing that happened first, pre-2017, is really just the institutional trading of crypto. And when we started Cumberland, that was around 2013, 2014. Many other institutional trading firms came in over the years since then. And the way I generally kind of like to talk about this is that as the space grew, as the valuation of crypto grew, the quote unquote degens became institutions, and the institutional traders just became larger and deeper in the market. So there's the homegrown institutional ecosystem, the things that have come up direct, or you can also think of Aave as an institution itself. So they're the things that have just grown to such an important size and import that you really have to think of them as institutions. And then you have had a really big basket of attempts to use blockchains in institutional contexts. Again, going back to 2014, JP Morgan's been at it since almost that long. Maybe 2016 is when they got in deep. So, there are a number of different institutions that have been doing this on their own terms for a long time, and many waves of private blockchains and their own instances, and we're in another wave of this with the corporate chains that are coming. So I don't think there's really one size fits all, and I also think we're still very early. But I would say that the headlines are the institutional adoption of crypto as crypto. Stablecoins have obviously hit an inflection point that is deeply compelling to a broader audience than just the crypto casino, and a growing ecosystem of applications of the composability of blockchains or the access to asset classes that were otherwise constrained in some ways, that are the early wave of broad RWA deployment into the ecosystem.
Right. And as far as your journey goes, how was it before Cumberland? What was the thought process to start Cumberland and then move on to start Digital Asset and Cantor Network?
Yeah, I mean, personally, I've been around the Bitcoin scene since around 09, 2010, and I was just personally very drawn to it. There was a very cool ecosystem of early Bitcoiners inside DRW, and there was a very lively internal conversation, and I traded a very illiquid commodity, long-dated natural gas futures. And there was a firm in the space, Centaurus, that their entire business model was, we'll make you a market in anything, no matter how liquid it is, but you've got to cross our two-way and we'll let you out. So you maybe would lose 50% on a trade, but not 100%, and you could get out if you needed to. And just the presence of that liquidity helped beget a bigger market. And so the general thesis around the early ideas for Cumberland were, well, we're a firm at DRW that's really good at taking risk. We're very good at trading, and we have a good balance sheet, so we could provide good liquidity in a space that lacks it. And by providing liquidity, will help the ecosystem become bigger and have a larger flywheel that builds around that liquidity. So that was the kind of overly simplistic idea. And at the same time, the idea was, well, you don't want to just market make something with a very small addressable market. So you should also be proactively investing in and building things that will grow the ecosystem. And at the time, my co-founder Yuval was spinning up DRW VC, and so he was very active in the venture space, broadly speaking, and started to do overlap with the Cumberland desk, looking at things in the crypto ecosystem. And one thing that was just very obviously missing was an institutional entry point into this broader crypto ecosystem, and not just from like a trading or a custody perspective, but to really use the rails and actually get some value out of it. So digital asset in 2014 was a very early idea of just something that was missing from an institutional support perspective for the broader crypto ecosystem. And it's taken us the better part of 11 years to really bring that full solution to market. And there's still plenty to do and a long way to go. But I think we've been quite prescient in terms of the things that have been missing, the things that need to get built, the sensitivities to what those large institutions need. And that has been the hallmark of how we've driven our product development roadmap and our features in the Canton ecosystem.
Like, what are those broad missing points that crypto has, and which is what the institutions have been looking for?
One was very obvious to us. Well, there's a small package of very obvious features that are missing from like a ledger perspective that were obvious to us, as far back as 2014, 2015, which was privacy is a threshold issue. It doesn't make any sense that anybody in the world would know how much money I have, or what position a trading firm has, or see every transaction, or know where their leverage is from. So privacy was such an obvious one. I mean, it was even obvious to Satoshi. You go into the Bitcoin Talk forums, he was very open and very clear about Bitcoin needs privacy to be really successful. They just didn't know how to do it. So transparency has always been the bug, even going back to Satoshi. And even before that, I think there was some, I don't know firsthand, but I believe Hal Finney used to talk about this even before the Bitcoin space. I know Zuko was as well. Transparency has always been the bug. That's always been the bug. That's always been crystal clear. And we knew for an institutional adoption or adoption at scale that this was really a foundational issue. That's one. Another is that there are these really subtle requirements around control that are really hard to put on like a quote card, but you see it expressed today in the deployments of chains where a consortium determine who the validators are. And they determine, well, this either needs to be jurisdictionally restrained or membership restrained, because we need to make sure that those are the entities that are responsible for the finality or the outcome of what we're doing. That set can be as small as one, sometimes it's bigger, but every use case has its own sort of trust model and legal position to come to market. I think it's a mistake to assume that it's appropriate that a giant pool of decentralized pseudonymous validators is appropriate for every asset class. It's an obvious requirement for crypto. That makes a ton of sense, but it's far less obvious that that's beneficial for a treasury or an equity. So this one-size-fits-all homogeneity of ETH or Solana or anything else where there's one pool of validators is partially what has given birth to the proliferation of L2s in competitive ecosystems. So choosing your own validator set, choosing your own infrastructure set, unlimited horizontal scalability, interoperability across all those different sets. You want to create one network of heterogeneous applications. You don't want to create a fragmented ecosystem of networks that kind of get patched together through messaging, but are more or less recreating what we already have. So those things were obvious on the kind of product feature level. What we benefited tremendously from on waiting to do the coin and having ballpark a decade of prior art of really interesting tokenomics developments is in the misalignment of incentives in a lot of these ecosystems. So the way I tell the story, and very much with empathy and the power of hindsight, is that the way ETH came to market way back in the day was, I'm oversimplifying, they might tell the story differently, but Bitcoin was smart contracts, and they inherited a lot of the design decisions of Bitcoin and tried to iterate where they thought they would be different. And what happened subtly is that they inherited the same incentive model. So they exclusively reward the infrastructure providers of the network. But where ETH found product market fit over the years is in the application layer. All the smart contract ecosystems really find product market fit in the application layer. But there are no incentives paid to those that are creating value in the application layer. So for example, Aave has not earned any mining rewards from existing in Ethereum. They charge ETH to their users. Of course, I understand that, but they don't get paid from the protocol for creating value. And in this way, I think that it looks really quite extractive that the infrastructure providers receive all the benefit of all the work of what the application providers do. So in Canton, 50% of all the rewards that ever exist and over the first 10 years go to the applications that drive volume in the network. So, just we've had the benefit in some cases of learning and seeing what others have done. That's like on the tokenomics side. And on the infrastructure side, I think a lot of that stuff was fairly obvious from the beginning. Although, clearly, since so few have taken it on, I guess daunting and hard to take on as a challenge.
So I want to get to Canton, I want to get to privacy, but I can't help myself from asking you a little bit more about Bitcoin. Since you've seen the complete arc of Bitcoin development, and also you're seeing Bitcoin from the institutional side, where it's kind of becoming a collateral in traditional finance. And I've seen a couple of your videos where you talk about Bitcoin as collateral in TradFi. First question is, how do you see the role of original Bitcoiners who kind of don't like the idea, or they at least sit on the fence about how the asset is becoming institutionalized? Do you think it makes a difference if there is DeFi on Bitcoin, right? I mean, if you can use BTC natively on Bitcoin itself. And yeah, how is the role of Bitcoin as collateral changing over the past few years, and how do you see it evolve in the coming years?
This is it's a really tricky question because I feel like I've been routinely wrong in my opinion about this, and time has proven that I've been wrong. So again, what I say here is, I'm certain that I will be proven wrong in some shape or form in the future. But I think that there needs to be some minimum amount of utility in Bitcoin as a pure store of value that can be really tricky for it to really have a long-term lasting effect. Now, you have to balance that with complexity, and I think a real strength of Bitcoin is its kind of stoic simplicity, and it's really straightforward. You could really only use it in certain contexts, and that actually paradoxically has a lot of benefits. So those two things are tricky to balance against each other. I think it's really appropriate that people would find ways to create DeFi and utility for Bitcoin via bridge mechanisms or L2 mechanisms. So it's like, okay, I've encumbered my Bitcoin in some way. I've introduced it economically in another ecosystem, and I can use it in another ecosystem. That feels quite appropriate to me. Feels like a decent use of Bitcoin rather than trying to jam it into Bitcoin itself. But I tend to be really quite careful about how much change you would introduce into Bitcoin, because I think it is one of its hallmarks. These other ecosystems they're set up better, I think, to experiment on some of that. I don't mean like experiment in their own structure, but in terms of how they use Bitcoin. There's more leeway there. So I think Bitcoin has been its own special animal in many ways, and I'm not quick to introduce things that would force major changes to what's going on in Bitcoin. But I'm also a little bit nervous about pure ossification. So I don't know, somewhere in this spectrum of it's good to do some changes, but they need to be very, very thoughtful in the search of the simplest, smallest thing you can do to introduce some safe utility. That's all.
Okay, and about Bitcoin's role as collateral in traditional finance.
I think this is a no-brainer. I mean, you have a really deep, because of that growing ecosystem of people that are using it as this macro asset, the depth and the liquidity in Bitcoin is really impressive. And that depth and liquidity And the utility it does have of being able to encumber it and transfer it 24/7 at any size, self-custodially or with tri-party or with custody, all of that is a real material amount of utility, and especially as a collateral asset. So that to me is happening is an absolute no-brainer. We see some really interesting examples of people using it to borrow capital, build infrastructure, lever that capital into other into other financial assets. So I'm very supportive of using Bitcoin in a very similar context that you would use something like a treasury. They're obviously not one-to-one the same in terms of their safety, but they both, I think, can provide very, very similar benefits in capital markets.
And how have been institutions using Bitcoin as collateral? I mean, what capital markets are already using it?
I mean, the two things that I think are happening at scale across every ecosystem on and off chain are using it to borrow cash. So, it's a good store of value. It has good liquidity. So it's a safe thing to borrow against, and it's a good thing to lend against because if I need to take delivery of that collateral, I can, and I can turn it into cash quite confidently. So just using it purely as a collateral and a cash position is very effective. The other thing is that it's actually a very cheap asset to borrow relative to cash itself. So there's using Bitcoin as collateral to borrow cash, and then there's just outright borrowing Bitcoin, unsecured or using it in other contexts. And it actually ends up being a really economical asset to use for your own balance sheet purposes. And for the derivatives exchanges that allow you to use Bitcoin to meet margin requirements or where the options are denominated in Bitcoin or ETH, like at Deribit, that tends to be a very, very capital efficient um, collateral asset for that type of trading. So I see that those two contexts are really adopted at scale already today. And that could be anything. You could be borrowing your Bitcoin to just get cash, and then you're buying other financial instruments. So you're using it the way that you might use standard collateral, or you could be using your Bitcoin to get a loan for a specific purpose, like to build infrastructure for your country or something along those lines. So there's a lot of different reasons that you could use that collateral in a lending and a borrowing context. And yeah, it's really no different than a mortgage when you think about it. It's something Yuval talks about pretty consistently. I have a piece of collateral, my house, I pledge it to my bank, I borrow cash, I use cash to do other things. It has a very, very similar, nice property, but I could do it in the click of a button because of the utility that Bitcoin does have.
In terms of the usage of stablecoins within the institutional context, like obviously in crypto, you use it as a base asset. Almost everything gets priced in USDC, USDT, and so on because of its close proximity to dollar, and it's just easy to price things in dollar. And they're used for inter-exchange settlements and whatnot. Right? Beyond that, how are institutions using stablecoins today, and how do you think that changes over time?
I'll be a little bit spicy that the institutions are not really using stablecoins today. I think there's this misconception that stablecoins have found radical product market fit. It is true, but only within the context of the crypto casino. When you hear people talking about the application of stablecoins for payroll or remittances or B2B transfers or corporate treasury, those are still quite early. I would not argue that they have product market fit. I don't think the full value chain of the full on-ramp to full off-ramp process has been proven to be materially more economical yet. And further, there are a number of contexts where it's just deeply inappropriate to use a public blockchain for these things. Kind of a silly example I like to use is imagine if you could pay your Uber driver with a stablecoin on one of the public blockchains. The moment I pay that driver, I'm going to have a lot of information about how much money he has on hand, how much money he's processed. It becomes actually a physical risk to that driver. Wrench attacks are popularly cited in Bitcoin, but can start to become quite prevalent with stablecoins if that was the means by which people accumulated and held wealth. And so these association attacks of pay someone, I know how much money they have, or how much money they have had, or how much money they have processed, or you start to learn a lot of information that could become very dangerous for the two entities facing each other. So the properties of cash and payments that we have today that really preserve this privacy boundary are actually really important for helping maintain some sanity and order. Or payroll, imagine doing payroll on most public blockchains. You're effectively leaking the salaries of all your employees and the bonuses of all your employees to each other. Most firms are not comfortable publishing that information. Some are. And the best answer that I've heard on how to deal with this on other chains is through hyper concentration. So I personally don't think this is a good answer, but it will solve the privacy problem if everybody just used Coinbase or if everybody just used Stripe. then it would be harder to do these types of association attacks. But we've also lived through enough financial crises and financial catastrophes over the past 50, 60 years to know that hyper concentration is not good either. So if we really believe in a broad, healthy financial intermediary ecosystem, then this starts to really be a major issue. So anyway, I think that the institutional adoption isn't really there. We needed regs. The Genius Act is a nice start. I think in many contexts, it's still not considered a cash equivalent on the balance sheet. So that's also a problem if you are a regulated, audited firm. The liquidity of these things in and out and 24/7 is also a problem. Lehman went bankrupt on a Sunday. So if I'm holding a liability on a bank over a weekend, I want some assurances that I have an exit or that I'm protected in some way. So there's a lot of like scale risks that people need to take into consideration, and I don't think that they fully have in the institutional context yet. So anyway, all this is to say that institutional adoption in stables is just getting started, and there are some really important primitives still missing at scale for it to be done, broadly speaking.
Right, and hyper centralization. I mean, that is kind of paradoxical to why this whole space started, right? I mean, you started because you didn't want things to be concentrated at one venue, and if everyone starts
Yeah, but I
using
mean,
Stripe,
I know where you're going with this, but like I'm a little bit cynical about it. I mean, look at the Bitcoin ecosystem. There are elements of it that are hyper decentralized, and then there are elements of it that are
Right.
hyper centralized. And there are real efficiencies to be gained by using, the appropriate intermediaries, but it is a risk that people have to account for. And I don't think that this space is yet mature enough to be able to identify what all those risks are, quantify all those risks, hedge those risks, price those risks, regulate those risks. And so I don't think a lot of those risks are worth taking. And it feels like every 2 years we get an FTX-like thing since I've been in this space going back 15 years. And it's like the world relearns and forgets the same lesson over and over again about counterparty risk, depository risk. And those things exist in cash too. It's not just crypto. Cash has very similar properties. So anyway, there are times when it's appropriate, there are times when it's inappropriate, but regardless, there's no black and white. It's a continuum of risk, and I just don't think that the space is good enough yet at pricing and understanding what these risks are.
I mean, you spoke a little bit about privacy. Like from what I've seen in crypto, like there are really like these two notions of privacy. One is like it's public, so everyone is able to view everything at all the times. And one is something like a Zcash where, at least in theory, nobody ever gets to see it. And I think real world is obviously always somewhere in between, where obviously I don't want my coworkers to know my bonuses and stuff like that, but the regulator wants to know, right? And because that is how my taxes are determined, and so on and so forth, right? If someone wants to do a credit check on me, they need to know how frequently I get money in my bank account, how much is that, and so on and so forth. But that doesn't mean that I want to disclose that to the entire world. I would want to disclose it to a certain number of people who, at least I need something from them or for regulatory reasons. Is that how you would frame the privacy problem? Like, where are we going wrong with privacy?
Well, I don't know that we're going wrong with privacy, but people, all too often in the crypto space, everybody wants to paint everything at the two extremes. And they don't want to start by saying, here's the problem I'm trying to solve for. So what we are not trying to solve for in Canton is the anonymous protection of information from anybody in the support of something like a global borderless censorship resistant money like a Zcash is trying to achieve. On a personal level, I like Zcash. I've been a big supporter from a long time. I have it in my PA, but it's nothing like what we're trying to do at Canton. If you sit down and you say, okay, Circle has it has a shape kind of like a bank in the sense that it is helping people access and facilitate payments and money movement. I know that there's a very important nuance about why they're not that, but if you say, okay, this kind of pattern matches to the way Chase works on the internet. Well, I think that it stands to reason that Circle must know what's going on with USDC at all time. I just can't imagine a scenario where JP Morgan calls their regulator and they say, great news, I can no longer see what's going on in 30% of my bank accounts. But don't worry, a black box gives me a thumbs up and says that it's good. I think that we agree in that scenario, it doesn't really make a lot of sense. So it's not that like anonymity is bad. Anonymity is just not appropriate in certain contexts, and it is in others. And there are risks that you take in the ZK and FHE implementations that are worth taking if you're trying to create something like a Zcash, but are existentially not worth taking if you're a stablecoin issuer. Is it worth taking any percentage risk that you don't actually know how much of your stablecoin is in circulation at any given time, I don't think that that's an appropriate risk to take. So yeah, the way you teed it up is very accurate. The world generally only thinks about the two extremes. Everybody sees everything, nobody sees anything, and then they have this really active fight about viewing keys, who should be allowed to get a viewing key and under what conditions. And honestly, we take a much more pragmatic approach and we just say, no, look, our Canton is architected in such a way that Circle must see everything that USDC does, period. And they're provided that guarantee. And if they want to permission Elliptic and TRM to be able to do the same, they need to be able to do that. And the protocol needs to be able to guarantee that Elliptic and TRM don't have to trust Circle, that that information that they see is the same thing that Circle sees. And if you're a holder, you must be able to do the same, but for your own activity. And if you're not one of those parties, you should not have any visibility into that. You shouldn't have any proofs of it. You know what, as a citizen of the internet with a browser, I'm on the internet right now. What role do I have, or what right do I have to know anything about what's going on in chase.com? It's not relevant to me. It's not relevant to me. I have no role in that. I think that's probably the only mistake that I see a lot of these chains making in their approach to privacy, is this sort of philosophical belief that the whole world should be able to prove that what took place was appropriate. Again, I understand it for a Bitcoin or a Zcash. But when we're talking about a stable coin, I fully trust that issuer and their banks to be telling the truth about how much is in distribution versus what they hold. They try to give me some confidence by doing audits. I get it, but I'm not continuously auditing their back end with the distribution. So the whole world decentrally validating the transfer of coins doesn't actually provide a lot of information to me as a holder, because ultimately I could be moving a coin around that's completely insolvent or not backed by something or has some weird liquidity problem. And again, the Genius Act is going to go a long way to help reduce those risks. But there is this fundamental relationship between the issuer of an asset onto chain and then forward distribution of that asset versus what they really have. And the decentralized validation of what's on chain doesn't remove that risk. So it's like, it's a very weird philosophical position to take, that I should be an active participant in the validation of stuff that, one, I can't validate what's real on the back end, and two, is not relevant to me in the first place. And that makes these implementations a lot harder than I think they need to be.
Right off the bat, how does if there are so many things that are customizable on Canton, how does a user know what application or is being seen by which provider or different parties?
So in Canton, you should think of this, it's a very abstract concept and it's very different from the other blockchains, but it has the exact same sort of conceptual structure of the internet, right? So you didn't know where every website was or everything like that on the internet today until we started to build really nice discovery mechanisms, like Google, right? And so it'll be very similar in Canton. Not everything is just public information, and even when it is, right? If you go to Etherscan, what has been really helpful is I'm doing a lot of indexing and identification and giving more information. So like discovery is a problem if you have a ton of stuff going on, if it's totally public, and if it's, I have to know where to go and then try to sign up and connect. In both cases, we have discovery problems. Canton's no different there. It's just a matter of building the right infrastructure to enable those discovery mechanisms to get built. But then, when you think about my phone, and I'm sorry, these are all a little overly simplistic examples, but I think they help create a mental model. My phone doesn't have every app in the App Store installed on it. So I do discovery. The things I want to interact with, I install into my phone. In Canton, this would be the node that I'm accessing the network through, the validator that I'm accessing the network through. My phone has my keys, like my passkey on my phone, and that's how I'm authorizing actions in these apps. Same things in Canton. Your signing key could be a passkey, could be whatever. It's very similar to like ETH in this regard. So I can't hit any RPC in the world and find my data or my apps. I can hit my RPCs in the world and find my data in my apps. And I could use my keys to authorize actions in those. So it's discovery, installation, and then my data is stored and held in those areas, and not anywhere else except when that is another party to something that I'm doing.
Can you take an example of Ethereum or Solana versus Canton and walk us through how different things work? Like, for example, how is the validator set chosen? How does data availability work, and so on?
Yeah, I think these are pretty stark differences, because I don't say this from any position of judgment or anything like that, but I actually think that it's not quite correct to call ETH or Solana networks from a physical deployment perspective, because they actually look a lot more like singleton databases. So you have one instance of this thing, and then there is an open public protocol on how anyone could update that. But because it's really one database, there's one set of validators for those updates in those apps. In Canton, it's a lot more under the hood, a lot of physically segmented infrastructure. So you can run your own validator set. You can pick a validator set from an ecosystem. You can run something centralized. You can run something decentralized. You can have your own infrastructure that orders it. You can use global infrastructure that orders it. So it's a lot more heterogeneous and like a network of networks than it is a single instance of something. So the most important thing is that's kind of the top down. The bottom up is when I'm a developer and I sit down and I design my smart contracts, then I design them the same whether it's a centralized party or a decentralized party or a pseudo decentralized. It doesn't really matter. I design the workflow of, okay, party A does this, then party B does this, party C should see it, party D can interact with it in this way. This data is disclosed here, et cetera, et cetera, et cetera. So you design that sort of workflow in this sort of interaction model. And then if one of those parties benefits from being decentralized, then I pick a decentralized party to play that role. So if I wanted like a matching engine to say, okay, I'm going to submit a bunch of individuals are going to submit bids and offers to this matching engine, then I want 30 validators in a pool to run a decentralized matching engine. The workflow is still the same. Buyer and seller disclose orders to matching engine party. Matching engine party returns fills. That's the general smart contract workflow. And then in the configuration, you just pick the party that is that operator of that matching engine to either be a centralized entity, if you're talking about like a NASDAQ or a NYSE, or a decentralized entity if you're thinking about something more like a DEX or a DeFi protocol. And there's no one size fits all. You just pick the right parties for your use case. And by the way, you can't force that on someone, right? I can't build an app and just go like, hey, NASDAQ, you're my matching engine now on this, right? They have an opportunity to accept that designation and play that role. But still, it's much more of like a marketplace of validator pools and configurations than it is just one default setting like you find in the other ecosystems. And then privacy is just done through segmentation. So the parties that you specify in that workflow, the nodes that are hosting those parties are the only nodes on Earth that C-store validate that information. So if you're not a party to something, you don't interact with it in any shape or form.
And who are the dominant users right now?
It's hard to say because you have some use cases. It depends on the dimension. Let's put it that way. So on one dimension, if you're talking about like notional, what matters a lot in the ecosystem, there's a lot of repo going through Broadridge. There are a lot of feeder funds coming online through one provider. There's a lot of commodity settlements happening through a consortium. There are a lot of mortgages coming online. There's a lot of life insurance policies being underwritten. So from a notional perspective, those applications are really, really large. The traditional financial institutions that are using it, the Goldmans, the HSBCs, the BNPs of the world. On the like daily volume, using the coin, there's a really cool ecosystem of new wallets that are coming to market, homegrown wallets, but also multi-ecosystem supporters, Copper, DFNS, BitGo just made an announcement. Fireblocks is coming. Ledger is live in restricted contexts. So we have a really nice ecosystem of wallets that are starting to drive user acquisition strategies. We have things like bridge to Bitcoin. We have stable coins. So there's a lot of, there's kind of what you would normally expect to find in any other public blockchain ecosystem are the things that are by volume the most active today. But by notional, the most active things are the things we've been working on for the past decade, the Broadridges, the Goldmans, the DTCCs, the HSBCs, the BNPs of the world. And those worlds are colliding very quickly. We have a lot of really fun use cases that are going to cross over between these ecosystems that you should start to expect to see, if not late this year, starting early next year.
And it's probably a silly question, but in those different domains, like what percentage of their usage has been moved over to, I don't know, should I call it decentralized rails?
Yeah, I mean, I do think about Canton as being fully decentralized. I think about the internet being more decentralized than something like a Bitcoin or Ethereum, because again, like I think about Bitcoin, ETH, and Sol as like this single app in a broader ecosystem. And the internet's more decentralized in the sense that I have a bigger heterogeneity of apps, and then every app governs themselves. So there's kind of no central governance whatsoever. So in my kind of real understanding of decentralized network, like the internet is way more decentralized than Bitcoin, ETH, or Solana. You could compare Bitcoin, ETH, or Solana to like a BitTorrent or something like that, but I don't think you should compare it to like the decentralization of the internet. So I do think about Canton as decentralized rails because I do think about the network as being a fully decentralized ecosystem. But there are apps in the network that are centralized in their context. It's just like Chase.com is clearly centralized in the internet context. I don't think that's a contradiction in terms. So if you're asking how much of the world has rotated on chain, I think it's still very, very small. And this has been my qualm with the I don't know if you remember, I think it's maybe a month old at this point. There was a DeFi llama argument with Figure about putting a lot of the HELOC information that they're doing into their statistics. And RWA.xyz as well was getting kind of caught up in all this. And what I find, frustrating about these arguments is that it's too much infighting. It's too much religiousness in the space. Our top level goal as a community should be to rotate as much of the world's economy on chain as we can. And there's too many Puritan tests. Like I have a deep respect for JP Coin because it is very hard as an institution as big and systemically important as JP Morgan to figure out how to adopt these rails. And what they're solving for is a different problem than what Tether was solving for. And so if you have a different problem to solve and a different set of constraints, you get a different result. And I don't think that that makes it an inferior result in any shape or form. It just makes it a different result. And we all benefit from understanding what they were solving for, what those constraints were, and whether or not their result gave them the outcome that they were hoping to get by being on chain. And that's very different from Figure. That's very different from Tether. That's very different from Aave. That's very different from Broadridge or Goldman. And when we filter those things out of the dashboards where we're supposed to go find this information and compare them to each other and all get a little bit smarter, because that doesn't count in whatever sort of puritanical way you want to say that, I think we lose the forest for the trees. And the credibility of those dashboards, for me, really comes into question, because now it's more about, well, what's the business model, and what ecosystem are you sympathetic to, as opposed to the true mission that in theory it says on the landing page. So I personally think they should be posting everything, and they should be going to the nth degree to help people understand what those constraints, approach, and outcomes were. And it really jumped off the page for me when I saw some really nice collateral from the Figure team about the amount of savings that they're driving into those products by doing this on chain and how they're getting those outcomes. I loved reading it. It was very informative for me. And, it gave me a bunch of ideas about stuff we can do in that broader Canton ecosystem. So anyway, I wish people would take this stuff more as inspiration and more as everybody taking a different bite at the apple. It's a massive, massive ecosystem to rotate on chain. We should be working together to make that happen, not saying one's better than another.
I mean, I was just checking, it's just 35 billion except for the stable coins that is on chain as per RWA.xyz. And I think that's a drop in the bucket of, what assets lie out there outside of our lazy niche bubble of ecosystem that we call crypto. But yeah, and for the viewers,
but I mean, if you go like looking at that number, I mean, it does not include Figure, which is like another 15 billion.
No,
it
I think
doesn't
RWA does include Figure. Yeah. In private credit.
Private credit. Oh yeah,
yes,
private credit. But if you scroll down the landing page, I don't know if you see in the RWA league table, but the first one there is Canton. Right there, that's one use case in Canton.
Exactly.
And that's, I don't know, as of today, it says 445 billion. It's hard to get. JP Coin is not on here, right? To the best of my knowledge. It's. I would prefer to be able to see everything in one place. That's all I'm trying to say. I'm not trying to be one way or the other about it.
Is it because JP Coin doesn't? First of all, can you walk us through what JP Coin does? You said that it's intended for a very different purpose than Tether. Can you just tell us what that is and why that is of significance, and how someone like RWA.xyz can go and find the numbers around it?
I mean, so they are a bank. They're trying to create a banking product. A stablecoin is not a banking product. They're trying to make sure that their corporate customers can move money globally at the pace of moving a stablecoin, but in such a way that it gets treated as a cash equivalent on the balance sheet, and it doesn't interfere with any of the capital treatments of the money that they hold. So these are all kind of capital markets, balance sheet, accounting, wonky things to understand. And I'm definitely not the expert on them, so I'm not going to dive too deeply into those details. But I know that in the case of something like a Tether, it was about moving money across crypto exchanges efficiently when crypto entities were being actively debanked, and getting good banking solutions was very hard to do. So that was one. Two, they're really great about extending access to the dollar into markets where the dollar is hard to hold safely and securely and permissionlessly. And I don't think that's, I don't know per se, this is conjecture, but I don't think that's a JP Morgan mission, is to get, dollars into the hands of people that otherwise can't do it in, emerging third-party countries or third world countries. So I just think that there are capital markets problems that benefit from the composability and 24/7 availability of assets. There are retail problems that benefit from those features. They get expressed in very different ways. And those things are better together than, if I could create and redeem stablecoins using JP Coin, that's actually a really interesting combination. Or if I can create and redeem stablecoins with US Treasuries, that's a very powerful combination. So it's the interplay of these things that I think are going to really change the world, not any individual single one of these use cases alone. It's the interplay of all this stuff together and the composability of things that becomes really a game changer for the world economy.
And as far as composability goes, I understand that Canton is very configurable in the sense that different developers or different applications can choose based on their needs. So it's more modular in that sense. But does it come at odds with composability in that case?
Composability is, I think, the most important thing that we as an ecosystem should be very protective of. And unfortunately, it's a complicated thing to explain to people. And so it's easily misrepresented, mismarketed, and let me make a positive statement. I think from a technical perspective, when you're talking about RWAs or cash or stablecoins, the technological breakthrough is composability. So it's the ability for us to incorporate someone else's assets or workflows into what we do atomically with zero operational concerns. We don't have that on the internet today. If I try to call the Bank of America API at the same time I call a Citibank API, I actually have to coordinate and reconcile those actions. I cannot guarantee the atomicity of that. So composability is the big prize in the RWA ecosystem from my perspective. There are 0 to 1 opportunities around just providing access or distribution or potentially fractionalization, but I don't think that those are unique to blockchain. So while blockchain might be a good vehicle for it, it's not unique to it. So I don't think those are durable long-term use cases at the value that people expect blockchains to present. I think composability is. And so where you find yourself in a scenario where, hey, my scaling strategy is L2s, I think that's very dangerous because you've lost composability. And I'm actually really, really supportive of some of the original philosophical positions that, something like a Solana took about how we don't want to horizontally scale, we want to vertically scale because composability is such an important thing to the outcome of our ecosystem. So I think people are not protective enough of how important this feature is. It's a core design principle of Canton is that no matter how physically fragmented the infrastructure under the hood is, virtually it's one network in Canton. Composability is true across the entire ecosystem. And that's always been like internally when features get contentious or people get in a fight about introducing features, it's almost always because in some way it might put composability at risk. And I think people are just not protective enough of that.
Can you just take an example of 2 different applications who probably have chosen a different validator set and how their assets become composable on Canton?
Yeah, in Canton, we pulled consensus apart in 2 layers. You have the validation layer and you have the ordering layer, and you have consensus at both layers. Your UTXO, so your smart contract instance, is validated by the stakeholders too. It's kind of like a proof of authority validation. You can layer as many UTXOs into a single update as you'd like, and they could be across completely different validator pools. They can have 0 standard share. Like they could be completely independent implementations. The only thing that they have to share for that composable update is a synchronizer. So they have to have on the ordering layer, they need to share an orderer for that single update. So as an example, I like to kind of use is, if you want to buy a Delta ticket using Amex miles, I have to move Amex miles to Delta and then buy the ticket on Delta. Things can happen where the ticket moves by the time my transfer of the miles comes through. Ideally, I would be able to transfer the miles and buy the ticket atomically. So I don't get the ticket if the miles don't move or if the price moves, and I do if everything works. That would be really, really nice. On Canton, if I'm just doing stuff in Amex, Amex is validating those transactions to however they've configured that, and they're ordering those transactions however they've configured that. For Delta, same thing. Those 2 worlds are completely independent, except when I'm trying to use Amex miles to buy a Delta ticket. And at that point, the validator of the Amex miles is still however Amex did it, the validator on the Delta ticket, however Delta did it. But then the ordering needs to be a common synchronizer between those 2 for that singular update. And that's really what the global synchronizer in the Canton network is that's the public permissionless zone that everyone is guaranteed to be able to connect to. So you'll always have at least that connection between you to do that ordering of that update. And that there's a lot more under the hood on that, but that's the intuition for it. And that synchronizer, that shared synchronizer for that shared update is really what guarantees the atomicity of all those updates. You still only validate the UTXO you're a party to. You don't see anything about the others.
Right. Okay, that makes sense. Yeah, okay. So there is this global synchronizer. So that is who's running that?
The global synchronizer
Yeah.
is operated by the super validators
Okay.
in the Canton network, and the foundation is helping oversee all the governance of the global synchronizer.
Okay, that makes sense. Okay. If I call it like the movement where most of the capital markets are using decentralized rails gradually and more because of whatever efficiencies that these things bring into their businesses. Who are the beneficiaries of this movement, and like to developers who are trying to tinker with blockchain applications and whatnot? What would your advice be to them if they want to build in this area? What should they be looking at?
I generally bristle against the idea of thinking about blockchains as being like peer to peer. It's very rare that individuals are interacting with the like foundation's self-custodial wallet that's very, very neutral. Generally, everything in these ecosystems is B2B2C, whether I'm coming through an exchange or a really great user experience wallet, like a ledger. You know, there are decisions that they make about what to highlight, what to prioritize, how to build that experience that does shape and color the behavior of the user. So even self-custodial wallets, if they have really nice UX and features, I consider that B2B2C. So if I'm a developer, I have this like silly analogy. I think about Canton as being kind of SpaceX-like in the sense that it is really, it came to market B2B, but the next wave of adoption of SpaceX is B2B2C. That is what really starts to impact individuals' lives. So using this really strong capital markets infrastructure and access to this ecosystem, what is a Starlink-like product I could build that gets built on the top of this highly differentiated infrastructure? And I like to try to think about it in that context. So like, could I build a credit card with differentiated fees? Could I build a DEX with privacy? Could I build a perp market with privacy? What would that allow me to do? And you know, the privacy element of this allows you to take things that are working in other ecosystems and say, well, what would privacy improve in this experience for users if we added privacy to it? So remittances, payments, payrolls, all that stuff is very accomplished, very easily accomplished with privacy in Canton. And but think about how you extend that feature to your user through a really nice experience. Not about onboarding your user directly to the ecosystem. I think that's kind of a misunderstanding that a lot of people have. Think about how to express this community and these features to your users through some really nice experience.
And what all out of the things that you mentioned is already underway or has happened in some way on Canton?
It's all underway.
Okay, it's all underway.
It's pretty cool. It's a pretty vibrant ecosystem. There's 600 plus validators connected. There are many wallets, lots of apps being built out. Wow, a lot of things rotating on. You know, we have tons of capital market stuff, but we have lots of stable coins, both online and coming online. We have wrapped and bridged Bitcoin variants, both online or coming online. We have early DEXs, early AMMs, early vaults, you know, early perps DEXs, early trading infrastructure, early collateral management stuff. There's a lot of really cool stuff being built in the ecosystem, and I'm excited to see all of it as it starts to land and really come online.
So a regular DeFi user, what can they go and try out on Canton today?
What can they try? So you mean like so like normally if I were to log in to like you know, Phantom and try some meme coins or something like that. Yeah, I think for the pure retail user, that stuff is still a little bit early. It's coming online, but there are some early DEXs that are starting to pop up. There are some nice wallets that are passing those DEXs through to the users. So you'll be able to get into some of the assets and the stables that are on Canton through those privacy preserving DEXs and swap facilities. And I'm blown away every day. There's kind of something new for retail, but I'm not going to steal anyone's thunder. People are announcing that stuff as it comes out, but it's going to look and feel in the not so distant future a lot like what you would in other ecosystems. But I would say with the caveat that I've not seen much emphasis on memes or NFTs or stuff along those lines. I actually think that sort of stuff benefits from transparency.
Okay.
So I'm not sure the privacy is additive there. And I haven't really seen a lot of interest in that stuff sort of coming over to our ecosystem.
So for a user who's like currently into DeFi and they have mental models, right? I mean, ETH is like old blockchain that is really slow, but like super secure. If I were to do on-chain lending in size, I'd probably consider ETH. If I want speed, I'd go to Solana and stuff like that, right? So what would be that mental model about Canton for someone who's a DeFi powered user?
Yeah, I mean, it really comes down to privacy. And when I think about how dangerous it can be to know everyone's position in these perp DEXs, to me, that's the obvious thing to do on Canton instead. is manage your inventory and your collateral and your risk on Canton. So if you think of like the evolution of DEXs as being AMMs and the ETH ecosystem, CLOBs and the Solana ecosystem, for us, I believe that our next iteration will be dark pools. Dark pools will really be the way to think about on-chain DeFi. And there's some cool stuff coming online soon for that.
What's the defensibility or what's the moat in the institutional DeFi or institutional blockchain space, if I may say so?
The moat. Yeah, I think the moat is really different at different stages. So right now, we really are the only ecosystem that can support privacy at scale in a compliant manner. Again, not the use cases of like Zcash or Starknet, but really institutional sort of privacy. So if that is important to you because you're trying to move stablecoins at scale, you're trying to do capital markets at scale, you're trying to do anything at a scale that would be above and beyond the low single digit billions that you find in a really big retail audience, I think Canton is really a no-brainer. But the long-term moat is in the strength of our capital markets ecosystem and how we tie all that together. So the example I like to give is, we were talking about a little bit before, but being able to create and redeem stablecoins with treasuries. It's a very sensitive workflow. Or if you're a large scale money market fund managing your treasuries and repo processes on chain, those are very sensitive things. You want the benefit of a blockchain, but you don't benefit from the whole world seeing all those activities. In many ways, it could be counterproductive. So the wholesale backend to apps and assets distributed broadly into other ecosystems, I believe will coalesce around Canton. And that capital markets network, the connectivity between TradeWeb and Broadridge and the DTCC and the banks and all that connectivity, and making sure that that all works together really well, and that the use cases that are enabled through that connectivity is differentiated. That's really the medium and long-term moat. The reason that that's happening almost exclusively in Canton is because of the threshold issues around the features in the ledger. But those sort of moats don't last forever, especially open source software, which Canton is open source software. So it really ends up being in the community and the use cases and the utility of the network.
For someone to come on chain with their treasuries and issue stable coins against them, and let those stable coins be either lent out or whatever that they want to do with those stable coins. For them to do it the traditional way, it would probably take longer. They would have to interact with different ecosystems for this to happen. I mean, there wouldn't be a single place where this will happen end to end.
I think a better way to think about it is just that we have better infrastructure for doing it. So, sticking on the example you just gave around the treasuries and the stablecoin, if I can only create stablecoins Monday to Friday Fedwire hours, and I have a fundamentally 24/7 product, that actually creates a lot of friction for me as the issuer. And in a perfect world, I would have a 24/7 product on the back end and the front end. That'll help me build a better product. It also makes it more attractive, right? So if people have that liquidity constantly, then that maybe is not an option that they use every day, but it's something that's really important to the safety and soundness of that asset itself. So I think about it more as the liquidity and the safety from a markets perspective, not like a technical perspective, but from like the depth and the capital markets connectivity to the back end of the product. That just makes it a more robust, interesting product. I'll give you a hyperbolic example. It's purely hypothetical, but imagine I issue a stablecoin and its collateral under the hood can only be accessed once every 30 days. And then there was a run on the stablecoin at 10 days. Well, everyone has to wait 20 days to know whether or not that collateral is good collateral or not, and they can get out of the stablecoin into that collateral. And that actually makes the desire for people to adopt the stablecoin lower than it otherwise would be. So it's obviously a very silly hyperbolic example, but that's one element of scale, which is just how illiquid or how slow that process is on the back end. But people become more sensitive to that as the notionals go up. So if I'm, from a personal perspective, thinking about how quickly can I move money between my bank account and my savings account or do payments, I don't really worry too much about that if I'm talking about a few $100s. But if you're asking me to make a huge investment in something, liquidity starts to matter a lot more. So I think about these things as being scalars. Can I build a low single digit TVL product without the sort of capital markets connectivity that we're building in Canton? Yes, people have done it. Can I build something that has significantly higher room to scale in terms of TVL and adoption and velocity if I have a really high quality capital markets backend to it? I think also yes. So it's not or, it's kind of an extension, a continuum, and a scaling factor more than anything else.
Thanks a lot for that. This was fun.
Yeah, thank you very much.
Alrighty, everybody, that is going to be it for today's live stream. That was the co-founder of the Canton Network. Hopefully you guys are paying very close attention to some of the projects that are flying under the radar right now. As always, if you guys enjoyed, do me a favor, smash that thumbs up button and subscribe on the Saturday podcast. And if at any point in time you guys want to dive into our vast collection of research, all the summits, all the panel discussions that have taken shape over the past consecutive couple of weeks / months. I mean, some of these are most recent, and the likes of are not getting any attention, hardly any views on any of these panel discussions, these summits that are taking place from the largest organizations, the systemically important banks, the projects that are going unnoticed, can all be found inside the private CyberX Discord. Head over to cyberxtrading.com. We'd love to have you on the team. Many blessings to you guys. Happy holidays ahead, as we do have the holiday stretch in the coming days. We have Christmas, we have New Year's, so on and so forth. If you guys are traveling, be safe, be sound, be aware out there. Stay cognizant. And with that being said, I will see you guys in the next live stream.